Welcome, everyone. Kevin and I are back with more information. Volatility, market turbulence. We had an ugly year last year. Will that derail your retirement? We're going to talk about that and look at strategies to help prevent that. You definitely want to stick around.
Yeah, I'm Becker. That's Orr. We're part of Becker Orr Wealth Management. We're a member of Canaccord Genuity Wealth Management. And let's dive right into this topic and start with volatility. What is volatility? Why is it important? Everything along those lines. Well, let's just sort of give that brief definition if we want to. Volatility is the movement of up and down and how fast and how far it can go. 20% up, 20% down. That's what volatility is in the market. It's usually not a smooth level. You don't get, 4% return each and every year without any sort of interruption going on. You could get a 15% year followed by -5, followed by -2, and then another 12% year. So volatility is the lengths that things will go in regards to what your investment portfolios tend to do. Right, Clint?
Yeah, and that's really the key concept here is volatility, because that's what could derail the retirement plan. We're going to show you exactly how that might happen. So let's quickly dive into an example here. We'll start off with two hypothetical investments given. Investment number one, you can see 20 years worth of return data there, year by year, all the way through. Because remember, if you're retired, you're probably going to be retired for a couple of decades, not just 5-6 years. So it makes sense to look at a 20-year horizon. In this case, investment number one in our hypothetical example, you put 100 grand in, you walk away, you come back 2 decades later, you got $320,000 in your pocket, an average return of 6% per year. Not too shabby. And you can see there's a couple negatives there, but the volatility, like you talked about, it's not 6% every year. There's some years higher, some years lower, a couple of negatives. We'll then look at investment number two here, Kevin.
Yes, investment number two.
So some bigger numbers, right?
Not quite the same. As you can see, there's more negative years here that we've got in it, but we're also dealing with numbers that are a little bit larger. You got a whole bunch of double-digit returns, both positive and negative out of this entire scenario. And over that 20-year time frame, as we can see, there's actually more money made. 66,000 more has been made based on the huge volatility we've gotten out of this. And we're getting an average annual return of 7%. But as we said before, notice that there's barely any years in here where there's actually a 7% return. You're either much higher or much lower, but the average over that 20-year time frame is higher than what you got out of the one before. And again, that's because you've got a lot more volatility in investment two than what you had in investment one. There's still volatility in both, but investment two over investment one, which usually means that investment two is riskier, is it not?
That's the idea. And then some folks might think, all right, there's more up and down, but the average return here is higher. You got $66,000 more in your pocket at the end. Well, clearly we're going to go with investment number two. And maybe that's the case if you have the risk tolerance to do that. But you have to keep in mind in retirement, there's a factor we're not looking at in this example, and we're going to have to add it in. And that is withdrawals. You're taking money out every single year. You worked really hard. You built up this nest egg. Now you're trying to use it to create income. Remember those examples, you put the money in and you just left it. You didn't touch it. It's a much different idea when you start doing the withdrawal. So let's add that to our example, and you're going to see a little bit of a difference there. But I'll set up the example first, Kevin. You're retired. You got $1 million in the bank. Fantastic. You got the big pot of money. You're taking $65,000 out per year, using that to spend and enjoy. If you had to guess, investment number one, remember that graph, that 6% average, you're taking $65,000 out per year. What do you think it'd be worth 20 years later?
Well, judging from the fact that just based on the numbers that I was thinking, maybe 6, 7, 800,000, somewhere within that range.
Yeah, right in that range, 700,000. You start with $1 million, you're earning that average of 6. Remember, it's not 6 a year, it's investment one. So you got good years, you got a couple negative years, but you end up 300,000 less than when you started, even though you spent 65 a year. And this is where I think people are going to be thrown for a bit of a loop. Investment two, which had a higher average return, 7% per year. So it's a higher number, same scenario. You actually end up with less, considerably less, $115,000 less because of the volatility. You're taking money out every single year in the good years, the bad years. But investment two had the bigger dispersion, right? The higher highs, but unfortunately the lower lows, and then a few negatives in a row. And that's really what does in investment number two. Would you agree?
Yeah, and I think that's the key here, right? I mean, if we take a look at where the two investment scenarios were with volatility, we saw that, there was a few less negative years in one, but they also started later. We also had in negative or investment two, the withdrawals for negatives started earlier. So if you have 3 negatives in a row, you've already taken away that 65,000 plus whatever the negative returns are. You're starting with a lot less principal again to try and build up, as you can see. So that's going to have an immense or a difference as to what you're going to get at the end of the time frame. Just because you've already lost a ton off the first three, now you're trying to make it up. Even with double-digit returns, it's going to be harder going forward just based on the lower amounts. So yeah, as we can see, volatility can have a huge impact when you withdraw money, as opposed to whether or not you're just saving it. When you're saving it, sure, nobody wants to care about it. But when you start to withdraw, you have to be concerned with how much volatility you've got in the market. Not only that, but how much volatility you put in your portfolio. That can have a huge impact, as you saw. $150,000 is not small, or 115, should I say.
Yeah, it is a big difference. And that's key. Like, what could derail retirement? Well, the volatility, right? Sometimes folks get caught on the return. Hey, did I make 6%, 7%? That is important, of course, but that's not the only factor. As you can see, is how you earn that return is very crucial when you're making withdrawals. Some of the key takeaways here, you can see between the two investments, there's more negative years. The declines are larger, and then you've got sequential declines. If you have 1 year of, -6, -8, really any single digit negative, not the end of the world. That won't throw the whole plan off track. If you get a -15, or you get 3 negatives in a row, and we're not talking 3 months, we're saying 3 years, that can be significant to the overall retirement plan, because you're taking money out on a regular basis. If you're not doing those withdrawals, well, different story. You can leave it alone. If it's your comfort zone, you can let it recover. It's a whole different calculation. But when you're doing those withdrawals, the volatility has a greater impact. And that's really what the math is showing us here. It's what we call sequence of return risk. It's a quirky title, but it really just means the order in which the returns occur, not the average, but the order in which they occur is very important to the outcome of your plan. Now, you can't control that, unfortunately, Kevin. I can't say in year 17, I'm going to get 6%. In year 14, I'll get 8%. You can't pick the order. No. But the crucial point here is the more volatile the investment, the more important the sequence of the return. So you can't control the order, but you can look at the volatility, can't you?
You can. And again, that's another important factor. And people might say, well, when do you ever see 3 negative years in a row? Well, it does happen. It's not a rare, it's not a frequent occurrence, but you have to be prepared for those sort of things. I mean, the way the economy moves, it is not an exact science. So you could get a variety of different things that go on, such as pandemics, such as wars, or anything else that can have a vast effect. So volatility is definitely there. And the sequence of return, as you mentioned, is something you have to look at. But again, you can control that aspect of it. I can't predict 6%, 8%, or 10%, but I can predict how much volatility I want in my portfolio no matter what. And that can be key to triggering how you get your average returns. Learning a percentage less, but maintaining that risk that's not there, that's probably much more important than trying to get that extra 1% and possibly having it really derail you at the back end.
Exactly. And that's really the takeaway there. The volatility is important, not necessarily just the average return. We talked about how that volatility could derail a retirement. Now we're going to give you a couple of tips, 3 of them, on what you can do to prevent it. You already really told us the first one, lowering the risk, right? You're controlling the volatility. So you have less risk in the overall portfolio. I'll go right to number 2, which kind of builds on that, but is to diversify the portfolio. We mentioned that in a couple of areas. The old saying, you don't want all your eggs in one basket. Definitely true here. If you have stocks, you also have maybe alternative investments or cash or GICs. You've got some other asset classes in there. So if the stock market gets hit, well, your overall portfolio might go down just because of the drop in the stocks. But if you have to do withdrawals and you have other assets that are doing better, you can take the withdrawal from those other assets and leave the stocks alone. You're not forced to sell when they're down. Another benefit of diversification. Also, there's a strategy called cash damming, where you might have a year or 2 worth of payments that are in the lower risk investments. Maybe you got some cash and a GIC on hand. So you got 2 years worth of payments kind of set aside. So if the other investments go down, well, you got some time on your hands. You can keep doing those withdrawals from the lower risk investments, and then hopefully the other ones recover within that time frame. Now, overall, diversifying, lowering the risk, you're going to squish the volatility. Also means you're likely going to see a lower average return over time. But as we just talked about, that's not always the most crucial factor when you're in retirement and you're doing these withdrawals. Now, this makes great sense on paper, Kevin, but sometimes the emotions get the better of us. You talk about your neighbor or your neighbor's friend's former bowling coach who made $1 million in crypto. It's hard not to want to take a shot at those larger returns.
Yeah, so many people want to chase it. I mean, that's the biggest factor. If you're sitting there and the neighbor next door says, you know what, I had 26% return last year. What did you have? Well, you had 8. Well, that just doesn't work, right? I got to get what did he have? I got to go after what he has. Now, the problem is that on the upside, everybody figures that, this is great. It's not risk oriented. We can go into it. But all of a sudden, if that next year there's a minus 20 pop, it's, well, I never wanted to have any of this in the first place. This is far too risky for me. Why did we get into it? Well, again, that's chasing returns, right? Everybody sees those double-digit numbers and, well, these guys should have that invested in my portfolio. That's not always the way it should be. If you do that, chances are you can easily get those big minus numbers as well. We've seen that in the market many times. It's played out over 100 years. Chasing returns does not necessarily mean that you're going to get the same sort of money the year after you've had a great return for one reason or another. So don't chase. That's important. And yes, maintain that. That's part of the volatility complex as well.
Exactly. This kind of gets to the Becker Orr mantra, kind of leading to it here. You want to have a plan. It's easier to maintain the emotions when you have a plan to say, okay, I need so much money per year. I understand how we're going to reach those financial goals. That really helps in those scenarios. Not perfect, right? Still can be enticing. Nope. Remember in 2020 when all the meme stocks are going crazy and all the crypto, it was tempting, right? But fast forward to today, and you saw some pretty big crashes in those areas.
Big time.
And that's what can derail a retirement. So ideally, avoiding that is key. And avoiding that means you're probably going to miss the upside in order to also miss the downside. Kind of part of the overall plan. If folks have questions, Kevin, how do they get a hold of us?
They go to our website and they go to chatwithclintonandkevin.com because we are more than happy to answer any of your questions on volatilities. As we've said right here in this example, we just used one that you can go. We can profile that to exactly what you deal with. How risk-oriented are you? How much volatility do you want in that portfolio? Again, visit chatwithclintonandkevin.com. Perfect for getting your answers out there. Otherwise, I think we've covered sort of that volatility and how does it affect your portfolio and your withdrawing sequences for today. And we're going to be back with a whole bunch more videos coming forward, are we not?
Absolutely. Actually, one more video I'll quickly mention. We talked about the average return. If you want to know the difference between time-weighted and money-weighted rates of return, money-weighted would include all the cash flows, which might be relevant for retirement. You can click the video that we'll link to right here. Otherwise, we'll see you again soon with the next video.